I'm going to look at when to use a financial advisor and when to use a financial coach, because I believe that going it alone throughout your whole investment journey is not a good idea, particularly around some pinch points, such as when you want to retire. And the key factors to look at are the amount of effort that you want to put in to the research and construction of everything that you're doing, and then the amount of money in terms of both income and wealth that you have. So Vanguard did some research around the value add from financial advice, and they put it into various categories. The first one is the suitable allocation of diversified funds. They felt that this had a positive impact, but potentially at zero. So they're saying it's not really about the funds you select, it's about how you go about managing those funds over time. The second thing they looked at was effective cost implementation of your investment strategy. So here they're saying if you use passive funds, then you might save money. So if you swapped out Fundsmith for a quality factor ETF, then you might save some money there. Next one was rebalancing. So this is where if a particular asset has gone up a lot, it becomes a large part of your portfolio. And then when it comes crashing back down again, you get a bad performance effect. But if you rebalance and keep your portfolio in check over time, which an advisor can help with, they feel that that will have a positive impact. The main positive impact was that of behavioural coaching, which potentially a finance coach can do as well as a financial advisor. And here they mean things like not panic selling when the market crashes and not chasing after the funds with the best performance. And then after you've held them for a while, that performance reverses and they become the worst performing fund. And this seems to be the biggest driver of returns around having someone look at your portfolio and help you manage it versus doing it on your own. Next one is asset location. I think this means putting money into a SIPP rather than an ISA, and then you get the tax breaks, and then that helps you out. And then linked to that is the spending strategy. So that's the order that you're withdrawing your funds. And again, if you've had your pension for 30 years and people want to get their hands on it and blow over the money as quickly as they can, but if they don't do that, and if they've got a coach or an advisor to help them, then again, that can have a positive impact. And then finally, a lot of individuals are a bit too obsessed with income investing and they don't look at the total returns. And if you more focus on the total returns, then you can again potentially get a positive impact. So if you add all this up, you've got potential value add from having someone, either an advisor or a coach, help you out of about 3% per year to have as an impact on your portfolio. So for me, all this does come with a caveat because Vanguard research, they generally write the conclusion and then do the methodology last because they did that research because they were opening a UK financial advice arm, although they closed it after less than 2 years because the take up wasn't very good. And I'm just a bit disappointed that a mutual company that should be run for the benefit of its customers would actually close something that they think can add value to those very customers. It all seems a bit odd, and I do take Vanguard research with a bit of a pinch of salt. So when we look at a financial advisor, they're actually straying into the roles of two different types of professions. So the first one is the tax accountant. So if you used a tax accountant, they could do your tax return for you and they could help you reclaim the pension excessive taxes and they would charge you a fixed fee to do that. The next one is the solicitor that could organise things like power of attorney, help you out with a will, put assets into trust for you. And again, they would charge a fixed fee, whereas the financial advisor is largely charging you a percentage of your wealth. So what you really need is perhaps a financial advisor that's well connected to tax accountants and solicitors, and then you can get this holistic package and even potentially save money or even get greater expertise. So as an example of an advisor straying into tax strategy when they shouldn't be, here's a St. James's Place fund, Apollo Private Wealth, that says, oh, here's a tax efficient way to fund your child's school fees. You sort of give them all the money and then you use their tax allowances. But people like Dan Needle of the Tax Policy Associates have said, well, this approach probably wouldn't work and could even result in penalties from HMRC. So you do need to be very careful who you're taking advice from. This chart looks at the role of a financial coach versus a financial advisor. So if we go down the financial advisor first, they'll help you invest and grow your money. They will provide you with options and help you meet your future goals. They'll typically charge fees as a percentage, which we've had that before. They'll also have a minimum asset level to begin the service, and that could be around £250,000, maybe £100,000. And then also for them, advising would be an ongoing relationship. So you sign up once, you pay the 1% fee, and then they aim to retain you for the rest of your life. So a coach, on the other hand, would be just a limited time arrangement, often around specific pain points. They can provide examples, give you some information, but they cannot make specific product recommendations. And they're also likely to charge a fixed fee rather than a percentage of your wealth. And the advantage of a financial coach can be that they don't have products to sell, so they're not going to sell you life insurance or some kind of annuity, and they're not under pressure to target certain funds and push certain things to you. So if you're starting out, I'd recommend reading books and joining online investing groups such as the Rebel Finance School by Alan Donegan that's on Facebook. This is free and you'll join a community of like-minded people. So reading books is a lot cheaper than paying someone by the hour to explain finance concepts to you. And the books, you keep them forever. They've got an index. So a couple that I'd recommend would be Reset by David Sawyer, which is a great book on just building your wealth. And then The Psychology of Money by Morgan Housel. That's good on all the behavioural finance issues. Another good book is Happy Money by Ken Honda. And this guy here, wow, he looks really unhappy. And he says he lost over £100,000 in the Woodford collapse. So we want to avoid that by getting someone to sense check our portfolio and what's going on. And the aim is to drive off into the sunset in our motorhome and be more like this Jimmy Cranky version of Nicola Sturgeon rather than this sour face looking, who stole my motorhome? So the fees of using a financial advisor can be very high. So you'll have setup fee that can be up to 5% of your wealth. If you're with St. James Place, you'll have a management fee, typically around 1% a year. There can then be an exit fee, St. James's Place, that's up to 6%. And then on top of just looking after your funds, you'll also need to do wealth planning, and that can cost from £1,500. So you need the wealth plan to go alongside the asset management because you need your advisor to be aware of when you'd like to retire, the sort of income you want in retirement, so they can build investing strategies around that. I think everyone knows the impact of compounding on higher fees, impacting a portfolio over a prolonged period of time. But in case you need reminding, here's a useful illustrative graph. And here's someone who wasn't that impressed by the quotes he got for some wealth planning work when he felt it was basically just plugging a few of his numbers into a spreadsheet. A financial advisor can get you good access to things like venture capital trusts or enterprise investment schemes, but these can be high risk and they should be only for money that you can afford to lose because the tax breaks could be offset by just losses in capital value. So with a coach, you can invest in anything on any platform. They'll give you some tools to analyze the best things for you. But most financial advisors won't let you invest in investment trusts with them and they're only as independent as the funds available on the platform that they use. So when you're considering a financial advisor, you need to understand what sort of funds they will be putting you into. So some of the tools that I use are firstly a correlation tool that looks at how the returns between different funds are related. So here we've got an Aberdeen small cap income fund that is fairly uncorrelated to other small cap funds, so would possibly be a good diversifier in a portfolio. And a lot of financial advisors will just say, oh, have a European fund, an Asia Pacific fund, thinking that that's diversification, but actually the economic drivers could be the same behind both of the funds, so they could actually end up being highly correlated and don't really serve you. And another thing that I do is look at the returns over maximum drawdown. So I look at how a fund is growing, then I look at the peak to trough maximum drawdown and the duration of that drawdown in months, and then you can rank your funds according to that. And if you're a bit risk averse, you can go for ones with lower drawdowns or ones that retain their highs fairly quickly after a market correction. A good coach will refer you to a financial advisor if they think it might be beneficial to you. For example, if you have a lot of wealth or a lot of income and they feel that their more simplistic analysis doesn't help for some of your financial planning. So financial coaches can help a client's funds grow until a financial advisor becomes more suitable. Outperformance can be elusive. Here we've got Fundsmith versus a global tracker over 5 years. And Fundsmith has £200 million worth of income every year, which is the 1% fee it charges on the 20 plus billion pounds of assets under management. And if it can't outperform with that amount of firepower to try and drive decent stock selections, then it can be really difficult to beat the market, and you're better off having a rock solid strategy formulated by either a coach or an advisor and then sticking to that strategy. So here's the perceived value from an advisor, and I would argue that a coach can deliver most of this as well. So the top one is sense of security and peace of mind, and that's really from just knowing the path that you're on and how your wealth should map out time. Next one is knowledge of your financial situation. So that could be things like the strengths and the weaknesses, the risks that your financial situation is potentially facing, and how you would cope with things like a market downturn. Third one is progressing towards goals, and something like a wealth plan can really help you to visualize the milestones that you need to achieve. And then the last one is the investment returns. From my work looking at lots of people's portfolios, I would generally conclude that people using an advisor tend to have too much money in bonds. That's because they filled in a risk questionnaire, and because of the insurance that a financial advisor needs to have, they tend to put their clients into too much of a cautious portfolio, particularly when they're very young 10 years away from retirement. On the other side of things, I find that people who are managing their own funds have too much cash, and they come to me and say, oh yeah, I've been meaning to invest that for a while, but they just resist pulling the trigger because they think something's maybe too expensive or the market's about to go down, and they don't realize that the best thing to do is just have a rock solid strategy and be invested, and that's something that a coach can help them with. Also, some advisor portfolios are too complicated. They feel like they have to put together a basket of several funds in order to justify the 1% fee, when someone like Warren Buffett is saying, well, just have 90% S&P 500 and 10% short-term US government bonds if you're in the US, and that will probably see you okay. So revisiting Vanguard's value add from having coaching and advice, I think that I can help people out with every single point on this list. If that interests you, just go to the portfolio coaching part of my website, www.ianshadrack.com. So financial coaches don't have to have any formal qualifications whatsoever. And that is why trust is paramount. And I believe that case studies build that trust. If you can see what someone does, how they interact with people, what sort of work they do, you can understand that, yes, okay, this is fairly similar to my situation, so I think this person can help me. And just blindly going onto someone's website and asking them a few questions, I don't think that really cuts it. So that's why I recommend you look at some of these videos that I've got and this specific playlist.